As an industry, we really tried to focus on the product itself and really tout the benefits of the product and not necessarily what the client was trying to accomplish in the portfolio. As we think about democratization 2.0, I think we have an opportunity, especially in private markets, to think more about and start with what the client's trying to accomplish and then work our way backwards. Does the client really need this? Does it actually work for helping the client achieve these different objectives?
Welcome to the Investorama podcast. I have the pleasure today to speak to Aaron Filbeck, Managing Director at CAIA and Head of Unifi by CAIA. He's a practitioner in private wealth management, and his work is regularly published in financial media, academic press, around many topics linked to alternatives. Aaron, welcome. Great to have you here.
Good to be here. Thanks for having me.
So, we've spoken to people from the CAIA before. We've spoken to Bill Kelly earlier, but I think it's good to remind our audience what is the CAIA, the role of the organization.
Yeah, absolutely. So CAIA, it's CAIA, so stands for the Chartered Alternative Investment Analysts, and we're a professional association, professional body. So we are focused on providing education, raising ethical standards in the industry, and we have a particular focus on alternatives. And I can get into kind of where we focus in terms of our educational programs, but anyone who is allocating to alternatives, GPs, LPs, regulators, academics, and so on that are in the alternative space is really where we're focused. We have 13,000 members globally. So 3 offices, one here in the Americas, one in Geneva, Switzerland, and the other in Hong Kong. So very much a global presence and a global membership body across those 13,000 members. And we're just over 20 years old. So we started in the early 2000s, really with the birth of hedge funds as an industry, and certainly over time, and I know we'll talk about private debt, that umbrella of what constitutes alternative investments has certainly diversified into many different sub-industries under that broader umbrella.
Wonderful. And I have to say as well to the audience that I have the CAIA as well. I didn't mention it, although I've said it in other episodes, but there you go. I'm a proud member, and I've interviewed quite a few CAIA members. Not that I have a bias, but Filbeck, my previous guest with whom we talked about real estate, also is part of the CAIA. And the association is changing. There's this new initiative called Unifi, which I think is very interesting, and I'd love to hear more about it.
Yeah, absolutely. Well, and a lot of what we've been focusing on over the past couple of years is just this whole move of democratizing access to alternatives. And particularly when you look here in the United States, the trends are starting a little bit more globally. The move from more institutions allocating to alternatives, institutions are still allocating a big portion of their portfolios to things like private equity, real estate, hedge funds, and so on. But there's been a pretty concerted move on the GP side and the asset management side to try to open up access to a lot of these strategies to the ultra high net worth individual. And so, you look at the past 10 years on the other side of the equation, we had record low interest rates, high public market valuations. And so people were looking at their portfolios and saying, I need something a little bit different. I need better diversified access to a lot of these different strategies. And so you have this supply and demand dynamic that really came together in the late 2010s, and new products coming to market that allow individual investors to access what a lot of institutions have already allocated towards. So at CAIA, the designation that we offer, and we've offered for over 20 years, is really a deep dive into a lot of these strategies. It's really focused on the allocator, the CIO, the GP who's in the weeds, who's doing a lot of the analysis. It's a very technical designation, as you know, having gone through it, very analytical and a very heavy hammer in terms of the number of hours to go through that program. But there's a lot of new entrants into this market, whether it's a financial advisor or it's distribution staff who are now looking at new product for the first time that really need just more of an understanding of how these things work on a more conceptual level They're not going to be an analyst. They're not going to be a CIO, but they do need to know enough to be dangerous, understand the jargon, and understand how these different strategies work. So at CAIA, we launched this platform called Unifi by CAIA, which is a learning platform. And the vision for this platform is to develop a series of programs that allow people that, depending on where you are in your learning journey, where you sit in the industry and your role at an organization, you can kind of pick and choose different educational programs that may not be as heavy or as technical or analytical as a high stakes credential like a CAIA or a CFA or a CFP. So we've got a couple of programs on this platform. Private debt, which I know we'll talk about in a little bit, is one of them. We also have our Fundamentals of Alternative Investments certificate program, which is a 20-hour online video-based certificate program that really gives you kind of an overview of the total alternatives landscape. So you're getting the 101s of hedge funds, private equity, real estate, and so on, that just get you kind of that foundational level of our industry. Where we're launching new programs are these micro-credentials. So private debt is one of them. We have one on digital assets coming out in the next month and a half. But these are deeper dives. So fundamentals may provide you kind of that overview, but if you're really focused on a particular industry like private debt or any particular asset class, we'll be stacking this library with a bunch of micro-credentials that are much shorter, 4 to 5 hours in length, that allow you to go a little bit deeper into that particular industry.
I've started this private debt, which is really a great course. There's so much to learn. I very much appreciate that kind of a lifelong learning in terms of the CAIA. I mean, I took my exam 10 years ago, so it's still somehow there, but having a refresh and also an update, etc., is so important. Is that also part of the vision?
Yeah, so one of the things that we did pretty consciously as we were launching private debt and as we think about future launches is, while, to your point, you may not be in wealth necessarily or within kind of this democratization, this wave that's occurring, but we have 13,000 members that, to your point, have taken the CAIA designation at various points in their career. I got mine 7 years ago, so it's been a long time, and the curriculum has certainly changed since then. So what we wanted to do is offer these micro credentials up to our membership as part of being a member of the association. And you can use this as a continuing education opportunity, if you will, if you're sitting in an advisor seat or a wholesaler seat. It's a nice kind of benefit as a member to kind of keep yourself updated. Private debt 11 years ago was a very different industry than it is today. So, hopefully there's a added benefit of having members go through it and, see what we're talking about on the Unifi platform.
Why was that the starting course? Is that because you see particular demand in terms of private debt, or was there another reason?
It's a really good question. And as we were kind of building this platform and thinking through the plan of the programs that we would launch, there's a lot of things on our list. I mean, we'd love to put 5 different programs, out all at once. But when we looked at what the industry was really paying attention to, where a lot of the growth had been historically, and really where a lot of the adoption and maybe confusion was occurring, was in this private debt industry. So when you look at the past 10 years or so, just over the 2010s, and all the different alternative strategies that are available to individuals and institutions, private debt was the fastest growing alternative investment strategy in terms of just growth in assets under management. So, you look back at the global financial crisis, this industry was, sub $500 billion in assets under management. And in about 10 years, we saw that growth go from that kind of small number to over 1.5 trillion in assets under management. So tripling in just about a decade. And the makeup of that industry has evolved quite substantially as well. So if you look 20 years ago, it was really distressed debt, mezzanine debt as well, were kind of the 2 primary strategies that were pursued in private debt. And it's much more diverse now. We've got direct lending, which really grew out of the global financial crisis, venture debt, which has grown, especially in the past 4 or 5 years as the venture market has really taken off. It's still small, but growing. The growth of asset-based lending, again, coming out of the global financial crisis. has grown quite substantially. So when you talk about private debt, that umbrella is massive. There's a lot of different sub strategies underlying it. So all of those kind of factors played into our decision for, let's take a look at this program. Of course, at the time, interest rates were rock bottom, so people were looking for income. So that's just an added rationale for, okay, everyone's kind of paying attention to this stuff. Do they truly understand it? And is this something that really makes sense for their portfolio? So maybe those are some of the factors that really played into our decision to launch this one first.
Right, and now there's more talk in particular, as banks typically fail on a Friday. Well, there's more opportunities or a bigger gap to fill in, and we're going to talk about it later. But before we even go into that, I also wanted to mention, as a private investor as well, that sometimes has bonds, how useful this has been to me, the private debt course, because it talks about so many technical aspects, whether it's secured or not, the land, the seniority, blah, blah, blah. And I have a bond that, for my sins, has gone bankrupt. And what I realized with other investors, so we've regrouped and talked about it, and we were all kind of hoping somehow there must be a process that the FCA in England or something will hold us by the hand. But I realized when normal bond becomes bankrupt or into restructuring, it becomes in this realm of distressed debt or private debt. The technical aspects are actually critical. Even in a 60-40 portfolio, if you have 60% bonds, you might as well understand what can happen.
And maybe just, if I could just pick up on that
Sure.
a little bit, and you probably saw this throughout when you're going through the program itself, we're trying to demystify private debt a little bit. I mean, there are some complexities and there's illiquidity and unique characteristics of the asset class and these strategies. But at the end of the day, debt is debt, whether it's public or private. And a lot of the factors and the fundamental drivers of return are very similar. You have to pay attention to things like capital structure, the interest rates, whether it's floating or fixed, credit spread, are a big driver of your long-term returns. And then, covenants are a big piece of this as well. Again, public or private. So, our starting point for the program is, hey, like this is a new industry and there's been a lot of growth, but you still have to start and go back to basics with some of these concepts that are really important when both analyzing loans directly or looking at a manager who's investing in it. So I think your point is spot on. Whether you're a public or a private fixed income investor, there are some similarities in that approach.
Yes, what has struck me as, let's say, a general principle, because we won't be able to go through the details, is how technical this is, right? They're all debts, but they all have different characteristics, things you should learn. And maybe that's kind of enough to know the dangers of being a tourist in that field.
Yeah, there's so many more decision points in fixed income. Equities are usually what takes a lot of the attention in the media just because there's a lot of volatility and on the public side. And then, of course, private equity has grown quite substantially in assets too. I think last mark I saw was close to 10 trillion in assets. So 10 times the size of the private debt market. But fixed income is a bigger market than equities in terms of just the paper that's out there. There's a lot of countries that still rely exclusively on debt to finance their operations. But even as you're structuring a loan, there's more factors to consider. Where do you sit on that capital structure? How long is the actual loan itself? Credit quality. So you're not just buying a bond like you might just buy an equity, which is equity. I own equity, you own equity. It's the same thing, especially in public markets. Fixed income has so many different other decision points that go into it.
If we look at the financial advisor point of view, what are they? Are there choices mainly to go via funds? Is that the approach? Is there sometimes a direct approach to private debt? Or when I say direct approach, I mean individual instruments?
Yeah, I would say, if you're an advisor, you're a wealth manager, most of the time you'd be accessing the strategy through a fund and looking at, a manager who's going to sub-advise. I mean, I guess if you get into the ultra high net worth or the family office space, you might do some direct investments, direct loan, but you need size and scale a lot of the times to do that. So accessing this through drawdown funds or, what we've seen more recently is this proliferation of semi-liquid structures, evergreen structures, interval funds here in the US. In the US, we have BDCs as well. So there's a lot of different flavors to kind of act this asset class, but mostly through funds. If you're a typical private wealth manager, you're not going to be doing a ton of direct lending.
As we said, we can only highlight the complexity. There's a couple of things that just struck me. And one, for example, is venture debt. And it seems to me like almost a contradiction in itself, because one of the stats you show in the course that 75% startups would fail. And therefore, how does that fit with debt? Because if I've got limited upside, which is typically the case of debt, a potential to 75% or something like that to go to zero, this doesn't seem like something that makes sense. I've learned now that there's a reason behind it, but it's kind of a paradox that I'd love you to talk a bit about.
Yeah, well, I think you're spot on. Venture debt, the venture market in general is, as we all know, very risky. There's a high degree of failure, especially on the equity side. Venture debt, again, is small but growing, pretty substantially in terms of just growth and assets under management. What you've historically seen in the venture debt market is the loans come after a couple of rounds of equity financing. So there is a bit of an established, precedent for financing, and it tends to be sponsored lending in the venture debt market. That's the vast majority. So you've already gone through, your initial seed, maybe A, B series financing on the equity side, and now you need, something to get you over the hump, in terms of financing growth, opportunities, and so on. So it doesn't remove the risk, to your point. There is still that risk of failure because it is relatively early stage. But what we've seen, and I don't have the stats in front of me, but defaults for venture loans are pretty contained. I think depending on the environment, sub 10%, maybe in a good environment, sub 5. So you tend to have the ones going for loans, at least historically, the defaults have been relatively low. But it is risky, and the returns of venture debt are not as high as venture equity, but interest rates could be low teens up to even low 20s, depending on the structure of the deal and the market environment. So there is a return for the risk that you take on, but you are operating in the early stage companies, to your point. So there is that fundamental risk.
Yeah, that's what I also find so interesting as an asset class is that you have this gap. Let's say, if I take a broad picture, what I would call the fixed income side, even the high yield things, it would be still single digits. Whereas you have instruments now in private debt allowed to go into double digits, so a different risk profile. And another one which I thought is quite striking is this distressed debt. And I think I remember from my CAIA course that it has some particular characteristic that makes it very, I don't know if counter-cyclical is the right word, but this is something that where opportunities are in bad time, and therefore it's such an interesting concept for investors and for the portfolio as a whole, right?
Yeah, and you're right. It is very counter-cyclical. The opportunity to invest in distressed debt is lumpy. You have these drawdown periods economically, or even within a particular industry. You can have a good broader economic environment, but for example, in like 2015, we had the big oil plunge, and so energy was kind of a place for distressed debt investors, even though other markets were doing okay. So there is kind of an opportunistic element to the distressed debt market. And distressed debt kind of straddles both public and private markets. So there are some managers that will loan directly to a distressed company. They're privately originating these loans to help them through a particular environment. And then you've got the public markets where distressed debt managers are coming in and buying outstanding, already broadly syndicated particular bonds in that environment. The reason why we include it in this program is because even though many of these managers are operating in public markets, and there are some in private, but public markets, when they buy these loans and you're a distressed company, there's a high degree of illiquidity. So even though it may be a publicly traded bond, historically, if you're buying these loans, you may be buying a substantial portion of it, and it may not be as easy for you to offload those loans to another buyer. And so the liquidity profile becomes much more illiquid than liquid.
Yeah, this is also what fascinates me about this whole private debt. If we zoom in just on distressed debt, there's different things you can do. You can trade it. You can have an activist approach, right? And so on and so forth. And how much specialized this industry and sub-industry is, and therefore, from the end investor point of view, being able to understand the basic concept is such a differentiating factor.
Yeah, I would agree. And especially, when you take a step back and look at alternatives broadly, and I think private debt's no exception, the dispersion of outcomes is very wide relative to traditional. Some of that is due to manager skill and their ability to deliver. But another piece of that is, the style that's being pursued. So like, private equity, where you've got different stages of the company's life, you've got different sector focuses, that all leads to dispersion. Private debt is the same in terms of either the strategy or the place in the capital structure, or in the case of distressed debt, there's multiple approaches that you can take. You've got more tradable strategies where you're not taking an active role. You've got these activist investors that are coming in, buying up the debt and hoping to convert into equity later on when the company turns around. So those different styles from an end investor perspective are just important to understand, because buying one distressed debt fund versus another, you're probably not going to get the same outcome depending on some of those factors.
Before we go into the portfolio or where it fits in the portfolio, I'm just going to show you this article, which is very recent from the FT. And perhaps the image in itself is enough. Maybe you want to comment on that while you take it all in. I just want to mention a couple of things in the article. Basically, it's an article about Blackstone, and they say they're very bullish, and they say the fact that the banks are retreating because the regional banks are dropping gives them a bigger opportunity. But Robin Wigglesworth has a lot of caveats, right? That it's crowded, that there's been too much activity, that a recession might wipe out the whole thing. If I was looking at the picture, I'd say, okay, is private credit the cool kid in this in today's environment?
Yeah, I think certainly it is the cool kid in terms of interest from investors. But let me just say, I'd love to see a movie with all four of these actors in it. So maybe that goes to the point of diversification in a portfolio. But back to our earlier comment on, you've got private credit right there next to liquid fixed income. They're more similar than different in a lot of ways. So I think it just goes to show, this isn't some reinvention of the wheel. It's just a different structure, has more complexity, and so on. But maybe I'll go back to my initial comment. This is a diversified portfolio in some way. So
yeah, I like that.
I'll leave it at that.
I can't remember the movie, but okay, great. And what do you think about, could it be overhyped?
There is a trend that I think is supportive of these strategies. Global financial crisis really kickstarted direct lending, and you don't really see the banks coming back in to make those loans. We were just alluding, and maybe, who knows, next week there might be another bank that fails. We've had a couple of really big headline bank failures with Silicon Valley Bank and Signature and First Republic and so on, where venture debt has an opportunity here. There's likely going to be some form of regulation and consolidation. The policymakers react to some of this that's occurred. So I think there is a supportive environment for a lot of these strategies in the private debt space. That being said, there's a couple of risks that are in this place as well. I mean, one, a year ago, interest rates were at zero. And now, SOFR has jumped up. I don't know the exact number off the top of my head, but maybe close to 5%. Yep. So your base rate has definitely gone up quite substantially. And so that spread that's on top of that, your interest rates from a pure headline perspective are very attractive. You're looking at kind of low double digits and maybe even mid double digits, depending on the strategy being pursued. But the bottom line is these companies need to pay those interest rates. And so, that's where you get into capital structure placement, credit quality, and, can these companies actually handle making those interest payments and servicing that debt? Or is this something that could lead to some kind of a drawdown? I think the other risk here is just because there's so many players that have moved into the market, the importance of manager selection and due diligence is even more important. You don't just have a few players that are, really specializing in this. Private equity firms are moving into this space. You've got a lot of newcomers. The number of funds that are being launched, there's a lot that's coming. And so, I think coming back to understanding the structure of the loans, but also the way the manager is implementing these loans in their portfolio, I think is very important. This isn't a panacea by any means.
I have to say, one of my previous guests, Edward Chancellor, wrote a book about interest rates and how, well, typically zero interest rate as they've been is an anomaly, and that typically leads to bad investment decisions. And the Filbeck, we discussed very much in detail the issues with Blackstone REIT and its potential, overvalued liquidity, etc. There's nothing like that in private debt. While we see this opportunity, how important it is to be empowered in order to navigate it at every level, right?
The rise of the semi-liquid funds in most of these asset classes is continuing. So you have the non-traded REITs. In private credit, you've got a lot of interval funds that are investing in this stuff. And a lot of these vehicles, are touting the benefits of periodic liquidity and your ability to rebalance and all of those kind of things. But at the end of the day, you're investing in a very illiquid asset. And a lot of these vehicles have the ability to throw up protections or gates for the investor. And so I think it's just important, good or bad, to just understand how these vehicles work and be educated before going in. Because if you're going into a semi-liquid fund and expecting that as soon as you want to sell out, that you can, that may not always be the case, especially when you most need it or when there's a distressed period of investing. I mean, most of the time when you want liquidity, it's when everyone else wants liquidity. And a lot of these vehicles will throw up, or just either by design or on a discretionary basis, they'll throw up those gates and kind of adhere to the documents of the fund.
Talking about education, it fills up the gap between the marketing and the small print, because obviously all those have small print, and if you read them, everything is explained, right? And the marketing is also regulated, but it's very easy for investors to focus on, well, when we say partial liquidity, normally I can exit, but if you really read into it, well, it's more complicated. And I used to work in financial marketing. I realized you're always pushing a little bit the boundaries on the marketing side. It's easy to lose track, I guess, of the fundamentals. But if someone that, for example, followed a course like this, well, you're much more grounded.
Yeah, I would agree. We've still got the picture up here. But, I think not getting distracted by the cool kid on the block and really understanding what are you getting yourself into is important, because you're right. I mean, a lot of these, especially on the more regulated funds or the semi-liquid funds that are there, these are explained in those documents. And so making sure that you understand that gates can be thrown up. Too many people try to redeem their shares, I think, is an important thing to understand before you go in and not be surprised when it does occur.
So what I would like to discuss now a little bit with you is how do we consider this in terms of portfolio construction? And can you give us some general principles of adding private debt into let's say, a normal portfolio?
There's a couple of layers to the process. I mean, one, you've got to start with the client, and you've got to start with what the client is trying to accomplish in their portfolio. So whether or not that's generating attractive income, there's a total return objective, there's a long time horizon versus a short time horizon. All of those qualitative factors and the client experience is a really, really important driver for your decision process. That would be step one. I think the second layer is your tolerance and your ability to take on illiquidity from a structural perspective. So back to kind of our earlier discussion on fund structure and semi-liquid versus fully illiquid. One, do regulations allow your client to get into maybe the more illiquid fund structures, or do they have to stay with the semi-liquid, or is there a behavioral reason why they want to be semi-liquid versus fully illiquid? So I think teasing that out and having that conversation with a client is an important thing, because that really kind of defines your universe of what you can actually access. So start with the goals, then get into the structure. From there, you get into more of the portfolio construction and the asset allocation decisions, which, as I mentioned before, private debt is such a diverse industry with a diverse sub-strategies, a lot of diverse sub-strategies underlying the industry. So you have a lot to choose from, and where you place it in the portfolio is going to be important. So if you're talking about, more corporate-based lending, like direct lending or mezzanine debt strategies, you may want to put that in a place where you might have, corporate fixed income, maybe even moving into high yield, depending on the credit quality that the manager is pursuing. And so that replaces that income component to your portfolio, hopefully a higher income with a lot of these strategies, but the risk profile might be similar within the portfolio. If you're talking more total return, or you're willing to take on a little bit more risk, then you might want to consider things like distressed debt or venture debt, depending on the cycle, because those will give you an opportunity to maybe source some even from equity, or maybe you're really aggressive high yield components of your fixed income portfolio, where you're playing a little bit more off in the overall portfolio. So it's kind of parsing out those sub strategies and then placing them within the portfolio and sourcing them from the more appropriate pieces. Maybe the last thing I'll say, and I don't know how far you've gotten in the course, but in the asset-based lending specialty finance section, there are some strategies that are there that are kind of esoteric and move in a different direction than broader credit. So if you're talking about insurance-linked securities or litigation finance or credit card loans or structured credit, those might move in a slightly different direction. And so you might want to think about, does this actually diversify both my credit portfolio and my equity portfolio? And then you're not really sourcing from one or the other or using it as a replacement necessarily. You're thinking more about the diversification opportunity that it pursues. So it really depends kind of on that underlying strategy. But maybe to summarize, start with the client and what they're trying to accomplish, go into the vehicles and the universe that's available to you, and then think about the role that it's actually playing in the portfolio, and use that, if you're sourcing from an existing portfolio, use that as your guidepost for where these different strategies go.
Yes, we don't have time to go further into that, but I think the audience would have listened to, the wide variety of choices, the importance of looking at it strategically, and navigating this asset class, with real knowledge, which is not a given. And that brings me to alternatives more globally. But what I hear just now is that this is not easy. And therefore, how can the industry navigate that?
Yeah, I know we were talking a little bit beforehand just about democratization 1.0, and I'd argue that we're in 2.0 or even 3.0, depending on where you think we sit in the life cycle. 1.0 was really taking hedge funds, and the hedge fund wrapper, grew pretty substantially in assets. We tried to take that strategy and then put it into more regulated fund structures, which, in most cases requires you to strip out some of the illiquidity, some of the leverage, and depending on the strategy that the hedge fund's pursuing, shorting might look a little bit different, or the derivatives being used might look a little bit different. So it works for some strategies, it didn't work for others. And I think as an industry, we really tried to focus on the product itself and really tap the benefits of the product and not necessarily what the client was trying to accomplish in the portfolio. As we think about democratization 2.0, I think we have an opportunity, especially in private markets, to think more about and start with what the client's trying to accomplish and then work our way backwards. Does the client really need this? Does it actually work for helping the client achieve these different objectives, and so on, and thinking through things like liquidity and not trying to be all things to all people. So my hope is, and where CAIA is really focused as a professional association, look, we don't have any funds that we're trying to sell. There's no product on our shelf. Our mission is solely focused on raising the standards and professionalism and advocating for the client. And then hopefully all of the other stuff, the product structure, what's available to them, kind of falls from that really important starting point.
Yeah, and with this democratization, again, there's a kind of an educational gap, and I know you've got a podcast, The Educational Alpha, because, well, there's so much more to learn, understand, comprehend, and that's what I like about finance. It's also never ending, right?
I mean, absolutely. I mean, we're very much focused on education. That's our calling card as an association. So education makes the investor more informed before going in. So that's our mission. I mean, we're trying to raise standards for the industry, but at the end of the day, we're providing educational programs, whether it's our CAIA designation or the Unifi platform, and where you fit within that ecosystem is up to you. But we're trying to meet the industry where they're at in terms of where they need education. And that should be your starting point before even moving into a decision of, well, should I allocate to this strategy versus that strategy? You can't make that decision unless you're well informed before even having that conversation.
Yeah, it's also very much what I have in mind with this podcast, etc., at a different level, a different audience. But we're at this stage where the opportunity is expanding faster than the rest can follow. That's where education is needed. Eventually, maybe it's all going to be regulated. I'm talking about long term. And therefore, when it's so regulated, it's less about your individual education and knowledge. But we're not there, right? We're far from it.
Yeah, and I think regulation plays an important role, and there's a balance between, overstepping versus not stepping in enough. And, I think having a sober view of that is important. But even if regulation does come into things, I mean, a lot of these liquid alternatives in the 40 Act or the UCITS mutual fund space are regulated, and people still need to understand them. When you look at, and Morningstar does a really, really good job of this investor returns gap survey that they put out on an annual basis, and you look at what is the fund earn versus what is the individual investor earn, and what's the difference between those different returns, and basically looking at, do investors actually stick with the strategy or do they sell out at the wrong times, and so on. Alternatives, the kind of the broader category, which we can get into whether or not that's an appropriate umbrella, has one of the widest gaps in terms of the investor experience versus what the fund is experiencing. I think a lot of that comes down to understanding how these strategies work. These are all regulated wrappers, but it's really a story of, do you understand what you're getting yourself into, and can you stick with that strategy over the long term so that it actually delivers the experience that your client ultimately wants and needs.
And who is responsible for bridging this gap, or let's say linking the opportunity with the ultimate investors, is advisors, right? One of your articles talks about a renewed importance of professionalism, or a new role of professionalism. Can you remind us of that?
Yeah, so we released a paper, and this is probably 6 months ago, called The Renewed Professionalism, which really just takes a step back. Given that we're a professional association, professional body, in addition to the education, we're constantly advocating for professionalizing this industry and putting the client first, thinking through what the client is trying to accomplish. And again, stepping back from that, the secondary considerations are the products and the asset allocation decisions and the portfolio construction. But this paper really focused on, what are some tools and some applications that we can think through to better professionalize this industry and help investment professionals think through, acting with the highest ethical standards.
Yes. So we're bringing the ethical thing, which is a topic for another conversation, but it's also one that we've discussed quite in depth with Bill Kelly. It loops in perfectly. And I think that was wonderful. Thank you so much. We will, of course, put the links to the Unifi program and the CAIA. Is there anything else that you'd like to add?
No, thanks for having me on. It's been a fun discussion.
No, thank you so much. And, we really look forward to what's coming next and how CAIA is evolving. In particular, this Unifi initiative is very exciting, very timely. It's exactly what we need. So thank you for that. And like I said, I'm almost done. I'm 60% into my private debt course, which I enjoy very much. So I'll let you know how it goes if I pass.
Yes, perfect. Well, thanks so much, George. Thanks for having me on.
Thank you for listening to Investorama, your guide to the future of investing without the hype. Please subscribe to the podcast and rate it on your favorite podcast app.